Hi, I'm Aaron Newworth with ETF Trends and ETF Database. I'm joined here by Chris Huemmer, Senior Investment Strategist at FlexShares Exchange Traded Funds. How are you doing today, Chris?
Great, Aaron. How are you doing?
I'm doing well. Let's get into it. In today's market environment where inflation concerns and monetary tightening are affecting markets, what are some strategies that investors are focusing on when adjusting their portfolios?
Yeah. Increasingly, investors are looking to control for risk in their portfolios. Uh, However, if we think about some of the traditional areas where investors go to lower risk, bonds and cash, those are areas that are struggling right now, particularly in, as you mentioned, the high inflation expectations, going into where we sit right now. So when you look at things from a real return basis, uh, where we're in a part where we're in a place where cash, even if you were earning anything on cash, and as we expect rates to go up, maybe there'll be some positive returns there, but still from a real return standpoint, uh, cash does not look like an attractive option. Fixed income is off to a pretty poor start to begin this year, and so a lot of investors we're talking to are as an alternative looking to adjust the risk within their equity portfolios. And one of the ways they're doing that is reducing the volatility by focusing on low volatility strategies that have the potential to mitigate some of that downside risk while still participating in the upside of equity markets.
So, when exploring different low volatility strategies, what should investors consider when choosing an approach?
I think the biggest thing that investors need to be aware of is when considering low volatility strategies, looking at the risk controls that are built into those strategies, particularly around sector exposures. Left unchecked, low volatility strategies tend to lean heavily on several sectors, things like consumer staples or utilities. Utilities in particular, you see if you are running unconstrained from a sector standpoint portfolio, you might get upwards of 20% exposure in utilities. And just to put that in context, utilities traditionally make up about 2.25%, 2.5% of the broad large cap equity market. So you're putting a lot of exposure on one sector. And what we find is that historically that you're trading one type of risk for another. So you're kind of robbing Peter to pay Paul in that you're trading volatility risk for macroeconomic risk. And that's particularly problematic today with the expectations of the rising rate environment. If you look at market expectations, where they're pricing in several rate hikes from the Fed of 50 basis points over the next coming meetings, and overall 10 quarter rate hikes throughout this year, with one already happening in March. So particularly when you look at areas like utilities, which tend to be very sensitive to interest rates, leaning heavily on utilities could be very problematic. And we see that even in a low rate environment. If you look historically over the last 3 to 5 years, not controlling for sector exposures has generally underperformed having a sector neutral approach to low volatility.
So, what else should investors be aware of when choosing a low volatility strategy?
One other thing that we find compelling is combining a firm's financial health with a low vol approach. So looking at things like their management of deployment of capital, their profitability, their management of cash flow, all comes into play. So things like what we look at in our quality score, we find to be really compelling with low vol. And one of the reasons behind that is historically the poorest quality companies tend to also be the highest volatility companies as well. So by eliminating the poorest quality companies from your starting universe, which is the approach we take with our low volatility ETFs or quality low volatility ETFs, it allows us to eliminate some of the companies that have been historically the most volatile, which allows for a better portfolio construction and allows us to do that while also controlling for sector exposures.
Great. Well, thank you, Chris. We appreciate your insights and look forward to chatting again soon.
Thanks for having me, Aaron.